Come with me to a magical place where being labeled the pork queen is a compliment, where being nice is just a way of life, and where all leaders of the free world must pass through. Welcome to Iowa. Whether you're a current Iowan, an Iowa expat, or an Iowan at heart, this show is for you. This is the Iowa Podcast. Real Iowans, real talk, no drama. From the Brady Dental Care Studios, I'm Justin Brady, and joining me today is Jim Plagge, the CEO of Bank Iowa. Jim, thanks for coming on the show. I appreciate it.
Glad to be here, Justin. Thank you for the invitation.
Obviously, we have to talk about banking because of the bank crisis.
Naturally.
So we're gonna get into. I promise everyone this will be actually interesting, but we're gonna get into all that. But first, have you subscribed yet? Every week we bring you a brand new Iowan doing something absolutely fascinating. It's information that you need to know. So if you like that idea, go ahead and subscribe. Apple Podcasts, Spotify, Google Podcasts, iHeart, everywhere. And Jim has already told his entire team at Bank Iowa to subscribe. Just kidding, Jim. You don't have to tell them that.
I will when I get back,
we
though.
Certainly hope you do. So there is a saying that the Federal Reserve raises rates until something breaks. So the first question is, I read that in the Wall Street Journal this morning because I'm a researcher. But the first question is, did something just break?
Something did break a bit. If a bank was properly managed and well managed, especially with their interest rate risk and matching up their investments and their source of funds, which is typically deposits, things didn't break. But there are always outliers out there, and the recent interest rate increases for those banks that didn't manage that properly. I won't try to get into too technical details, but it ends up with you end up with an unrealized loss on your investment portfolio. And that's okay as long as you can ride those investments out until maturity or until the interest rate environment changes again. But in the case of SVB, they needed to sell those investments to meet depositor demand, withdrawal of funds. And they took a big loss on the sale of those investments because they were lower yielding investments than what the market will allow for today. And they're done.
Yeah, absolutely. So the Dow this morning, it's Wednesday, obviously, the Dow dropped 500 points with banking fears, according to the Wall Street Journal. And this is apparently, I didn't know this either, but this is the second biggest failure in U.S. history. So I don't understand how quickly this happened, because during COVID, at least for Silicon Valley Bank, deposits were at a record. This was 2021 was their most profitable year ever. So is this as simple as the treasury bonds, mortgage bonds values got crushed because of rate increases and they were sitting on a bunch of treasury bonds and lost all that money? Is that basically how that worked?
Yeah, I think two things happened here. All banks, I think SVB especially, because they were in the private equity, venture capital, fintech arena, they really saw growth in their deposits. But all banks during COVID saw substantial deposit growth. We experienced here in Iowa stimulus money, people not spending money during the first parts of COVID because we couldn't go anywhere. So we all experienced substantial increases in deposits. So now we're all sitting there flush with deposits. What do we do with this money? Do we just sit on it and not earn anything on it, or do we put it to work, as we say? You try to put as much of it to work in the loan portfolio, but that doesn't happen overnight. Whereas you can put it to work overnight in investments. So buying treasuries, buying mortgage-backed securities, buying agency bonds. That was the devil's bargain, shall we say? Should we put it to work, or should we sit on it and wait for another day, or see if this liquidity is going to go away? SVB went all in, the way it sounds, on longer-term treasuries, longer-term mortgage-backed securities. And so they were very heavy in long instruments. So when rates went up, then they experienced a substantial unrealized loss on those bonds. And then they needed the money. It was just a storm of bad events for them.
Yeah, I mean, it really was the perfect storm for them.
It was, yep.
So I think this is helpful to understand how the bond market works.
Yes.
Because Iowa podcast listeners, according to the research we've done, really briefly, the research I've done, are pretty savvy. They get pretty much everything. That's why they listen to this show. So I think we should go into just an overview of how bonds work, how treasury bonds work. They're normally considered a safe investment.
And they
right?
are certainly from a risk standpoint, yes.
Yeah. So in this case, inflation basically hurt the safety of that investment.
It hurt the market value of it. So this was the exact same conversation I had with my wife about 2 nights ago when I was trying to explain this to her. And she's a smart woman, but this was something new to her. It's much like your listeners. This is something they don't deal with on a day-to-day basis.
I feel like I'm a smart guy, but this is new to me too.
Yeah. You know? So let's assume 2 years ago, you bought a 10-year treasury yielding 2%. Mm-hmm. So you now own a piece of paper, or you own a bond that's paying you 2%. Rates are now 5%. So let's say you need to sell that.
Yeah.
You need the money. So
yeah.
you have to sell it. Well, nobody out there is going to buy a 2% treasury from you when they could go to somebody else and buy a 5% treasury, a treasury yielding 5%. So in order for you to entice them to buy it from you, you need to discount the value.
Right.
So if it's if it's $1,000 treasury, they're bigger amounts than that. You would need to sell it for, I'm making up numbers here, you would need to sell it for $950.
Right.
So you took a $50 loss on your treasury. Take that times literally billions, and you have the SVP or the SVB problem.
Right.
Yeah.
So basically, is this an oversimplification? You can clear this up if you want to. I encourage you to.
Yeah, okay.
So is it an oversimplification to say that bonds, treasury bonds, mortgage bonds, that kind of stuff?
Mortgage-backed securities.
Mortgage-backed securities. Is it an oversimplification to say that's it's kind of like the stock market, but you're not investing in companies, you're investing in the Federal Reserve or the government, and is it kind of the same? Are they bought and sold kind of the same way?
They're bought and sold very similarly, but with mortgage-backed securities, treasury bonds, agency bonds, and when I say agency, I mean United States government agencies.
Yeah. Mm-hmm.
There really isn't any credit risk there theoretically because they're backed by in the case of treasuries and agency bonds, they're effectively backed by the full faith and credit of the United States government. In the case of mortgage-backed securities, they're backed by pools of home mortgages, which in turn are securitized and pretty much guaranteed by the government. So from a credit risk standpoint, there really is none. They're the diamond in the credit risk environment. But from an interest rate risk standpoint, they're subjected to interest rate risk just like any financial instrument is. Stocks and stocks will typically move in inverse to bonds because in a low interest rate environment, oftentimes the economy is coming out of a recession or doing well, and so bonds are yielding poorly. If we're in a inflationary period, the yield on bonds is going to go up, and that usually means the stock market goes down. That's typical. Yeah. It doesn't always happen that way.
All of this is general, typical, because it's, we're always going into new territory, it feels
so there is no failure risk. If you buy a stock, you risk the company failing. Mm-hmm, mm-hmm. You could lose all your money.
Absolutely.
You're not going to do that with a mortgage-backed security or with a treasury. You're going to get your money back. It's just a matter, is it going to be a premium or is it going to be a discount due to interest rates?
Right. Yep. So if they would have waited, which obviously they couldn't, but if they would have waited, maybe they could, I don't know. They would have gotten that money back. It was just a matter of they needed it now, and so they were forced to sell things at a loss.
They needed it now, because their depositors were knocking on their door. And that's the classic bank run, which hasn't happened for a long time. Usually banks fail because they have problem loan portfolios. They have credit problems, so the capital of the bank disappears because they have problem loans. That doesn't appear to be the case here. Although, as the FDIC now digs deeper into the loan portfolio, perhaps we'll discover that there are some loan problems there.
Yeah. So, do we see people hesitant? Do we see banks hesitant to invest in treasury bonds and mortgage-backed securities in the future because of this?
I don't think so, because again, not because of credit risk, but we're all going to be, when I say we, banks, I suspect we're all going to be a bit more conservative in managing our interest rate risk. And that's something we do on an active basis. I mean, it's not just something that we that we take guesses at. We run very sophisticated modeling to determine, okay, what happens to our bond portfolio when interest rates go up, when interest rates go down. We also factor into that what we think our deposits will do in upward and downward interest rates. Will our deposits grow? Will our deposits shrink? If we expect deposits to shrink, what's our alternative sources of liquidity to meet our depositor demand? So it's a very sophisticated system. We put a lot of work into it, but sometimes, when 25% of your customers show up at your door and want their money, that is not in the modeling.
It's the what is it? It's a wonderful life problem.
Yeah, exactly.
Right?
It's that writ large.
Yeah,
yes.
Your money's not in the bank; it's in everyone else's houses.
I actually thought of that over the weekend.
The SVB should have just played that clip, and they would have been fine. March 6th, the FDIC chair announced banks were sitting on basically $620 billion of unrealized losses, right? And so I don't know if I have the number, but I want to say, here it is, 17 billion of that. 17 billion was in SVB. Yeah. So clearly they had, I don't know if the right term is over-leveraged themselves there. Is that the right term?
They didn't over-leverage themselves, but they certainly went all in on long bonds. Yeah. Most of us have a bond portfolio that is maturing over a period of time. Some of it's always going to be coming due. So if an instrument's maturing in 1 year, for example, even if interest rates go up significantly, the unrealized loss on that bond isn't going to be that big because there's not much time.
Right.
If it's a 10-year time period, on the other hand, then it's going to lose a lot of market value.
So is this kind of an Iowa way of thinking? Because ever since I've grown up, Iowans, they don't do crazy stuff. They're very calculated. They're very careful. They progress slowly. Mm-hmm. And sometimes we get a little criticism for that. But in times of recession and chaos, no one's criticizing us for that. So is Iowa going to be insulated from this problem because of that, or do we have a little bit of risk here?
I think by and large we'll be insulated. I think the industry as a whole is insulated. It's really a matter because SVP and Signature were certainly outliers. Number one, because they were, in the case of Silicon Valley Bank, they were dealing with fintechs, private equity, venture capital. Not only the individuals who invest using private equity or venture capital, but also the companies that are taking that money. Right. So they were on both sides. So they were just dealing in a very volatile industry to begin with.
Right.
Signature was in cryptocurrency. We all know what's been happening there.
I was going to ask you about that, because did that negatively impact their position?
Yeah, it did. I think they've had the same problem from us. The depositors wanted their money. Now, they didn't have the bank run. It's been a slower bleed for them. But again, all the uncertainty out there just creates more problems. And then once that ball starts going down the hill, it's hard to stop it. So I think in Iowa, to your point, generally speaking, the banks are very conservatively run. I don't expect there will be a problem unless that ball starts rolling down the hill. Then it's hard to stop. Right now, we've not seen it. Hopefully, the worst is behind us as far as the bad news. But if the ball starts rolling, then we're all going to have to figure some things out. Now, the Fed and the FDIC and the Treasury just announced a program that's going to provide additional liquidity to banks. They will actually, lend to banks based upon the par value, the nominal value of your bond investment, of your bond securities, not the market value. So that, rather than forcing us to sell those to meet liquidity needs, we can borrow basically 100% against them.
Yeah. Now, so are you referring to the bank term funding program?
Yes, exactly.
Yeah. Yep. Okay. So can you explain I'm 16?
Yeah.
Because my family will tell you I never really matured past 16 anyway.
Well, most of us didn't.
So could you explain I'm 16?
I'm 62 and my wife said my frontal lobes came in about 10 years ago.
Oh, man. So I'm 16. Can you describe how the bank term funding program works and really oversimplify it for me?
So the purpose of it is to allow banks to meet their liquidity demands. And when I say liquidity demands, I mean depositors wanting their money. So prior to this program, this is what happened to SVB. Depositors wanted their money. The only way that they could give them their money is if by selling their parts of their investment portfolio and selling them at substantial losses, which then crippled their capital position. Now they're insolvent. That's when the FDIC comes in. So the term program that they just announced, it's an alternative to having to sell your investments. We can simply borrow against them from the Fed, basically at 100% of the amount we invested in them. So that provides us the cash we need to meet depositor demand. It doesn't force us to sell those investments, because if you have a bunch of banks trying to sell investments, the value is just going to continue to go down. It's just going to become a snowball, and because there's not enough buyers out there.
Right.
There's just not the classic supply-demand dilemma.
Yeah. So it's helpful to know the FDIC in all cases insures people at a bank, at an FDIC insured bank, and it protects people up to $250,000. But in this case for SVB, they went beyond that rate. It sounds like, according to the president and according to regulators, they've gone beyond that. Is this unusual?
It is very unusual. It's in both Signature and SVB. That's the only time they've ever done it. They are making all depositors whole. So no matter how much money you had, they're going to give you your deposits back. And I understand the reasons why, because if all of a sudden depositors were losing substantial amounts of money, that could certainly significantly impact the entire system. So I understand why they did it. Part of me doesn't like it, because the way the FDIC is, the Deposit Insurance Fund is going to be reimbursed by that, is they're going to make assessments on all FDIC insured banks. So we're all going to pay our pro rata share. And when I say pro rata, if a bank has 1% of all the deposits in the U.S., that bank is going to pay 1% of the losses that were incurred by the FDIC. Yeah,
like any insurance program, like I have to pay a monthly cost for my car insurance. Those fees come out of you. All the banking fees that we see, all the overdraft fees, stuff like that. That stuff is in part, right? Because you need to be profitable. You need to make profit and pay people. But also that's going to pay into FDIC insurance. So you bring up a good question, which is, because of the SVB fallout and them having to reimburse everyone, and if they can't sell enough assets to compensate everyone, do your fees go up? Like, do we in Iowa, in a way, it's not a tax, but it's kind of like one. Does that start to happen?
Well, in theory, all costs get passed on to the consumer. So that whether it's income taxes that a corporation pays, or whether it's just the expenses they are forced to incur as a result of regulatory measures, theoretically all of those get passed on. They don't get passed on directly, but to the extent that we're trying to achieve a certain profit margin, then we have to make adjustments to try to achieve that. And it's hard to narrow it in that accurately on a profit margin. But we already pay FDIC. All banks pay FDIC insurance. We pay a premium to the FDIC for that insurance, just like you pay it for your car. But now there will be a special assessment on top of that. And I believe back in 07, 08, during the bank failures, there was a special assessment for a few years as well. So this has been done before.
Oh, so this is a thing.
Yeah.
Oh, got it.
We didn't like it then, and we don't like it now either, but
So is there going to be, because I'm assuming the FDIC, they have announced this is like a special thing they've done. And so that kind of indicates that, hey, don't get too comfortable. We might not do this again in the future. So is there going to be a move then for people moving money around to keep it underneath that $250,000 cap?
I think there's certainly going to be more awareness of it, especially, I would think, especially for consumers who aren't accessing those funds typically on a day-to-day basis.
Right.
For businesses, it's going to be especially problematic because, if you've got a business that has $1 million payroll every 2 weeks, it's virtually impossible to keep your deposits at one institution below $250,000. So I think there's always going to be some risk that businesses are going to be exposed to under the current program, under the current limit. it won't surprise me if we see the FDIC come out with a higher limit.
They've done that a lot
for businesses.
History,
They're, you know, if you meet certain qualifications, there is a higher limit. Again, that the banks would have to pay a higher premium because, of course, we're covering more deposits. But it won't surprise me to see some sort of changes to the FDIC program, especially as they relate to businesses.
Yeah, sure. No, that makes a lot of sense. So, but do you see consumers also moving money into?
A little bit. I mean, we've had a few phone calls, generally speaking, our clients. Oh yeah,
wow,
our client, but they're comfortable, and there's ways you can manage your funds. So, for example, if you have $250,000, Justin, and your wife has $250,000, you can each have $250,000 in a bank in your individual names. You can also have $500,000 jointly between the two of you. Because so there's ways you can structure your deposits to have well over 250. If you're a married couple, for example, there's ways to have way more than 250,000 if you structure it properly.
And you can I think you can put certain accounts in your children's names too if they're dependents.
Yep, correct. And in trusts, and there's various ways to structure it.
So, I mean, is it as simple as, and I don't know if I want to encourage this, but is it as simple as just telling my bank, hey, I want to open up 3 new savings accounts. Can someone do that? And
absolutely.
Is there concern on the banking side?
Not really. It's just obviously we have to set up 4 accounts instead of 1, but we can do that rather quickly. And if that's what it takes to retain your deposits, we'd much rather do that than have you go move it to 3 other banks. Right.
Okay. Got it. So it sounds like this will probably be a opportunity for some kind of technology solutions. Like, I mean, I've wanted for years the ability to manage my money in a folder kind of system, right? Because from a budgeting standpoint, I have that on paper, but it would be nice to have that those different budgets reflected in a folder kind of system. So I wonder do you think banks use this as an opportunity to give more banking products to consumers?
I would guess that will be coming, that we will all be more proactive in helping our clients manage their funds to stay within the limits. It obviously creates more work on our part, but there's a payoff for it if it retains the deposits.
Right. Now,
which is our goal.
Yeah, I mean, there's also the term deposit swapping is also something, and this is, help me understand this, but this is basically where banks on the back end swap deposits to keep them under that $250,000.
Yeah, there's various programs out there. CDARS is, and don't ask me what that stands for. I could come up with it if I needed to, but
that'll be in the lightning round.
Yeah,
later.
There we go. Okay, there's a program out there where if you've got $1 million on deposit with us in a CD, we can basically break that apart into 4 different pieces. We'll sell off 3 of those 250,000 pieces to another bank. They will in turn, or the whole system in general will sell us back 3 pieces of 250,000. So we still have $1 million on deposit, but it's technically with 4 different borrowers. Even though on our end it's still in 1 account, it is all FDIC insured, because in fact we have customers who are in that program. They weren't with us, but we were aware of it. They were managing CDARS through another bank, and they discovered they had money with SVB.
Oh.
so they'll be learning about the FDIC reimbursement plan here.
Oh my word!
Yeah.
Okay, so
and it'll happen seamlessly for them. They won't have to do anything.
Right.
But so SVB was getting some. They were participating in that program.
They were participating in the deposit swapping program.
Yeah.
So some other people in banks unwittingly had money in SVB because of that thing that's trying to insulate people from the $250,000.
And when you're in that program, you do get a report that shows where your funds are, so you know.
Sure. Okay.
And they try to be very proactive in only putting them with banks that they think are safe, because they don't want to deal with this either. They meaning the company that runs the CDARS program. But occasionally there's a miss there.
Right. Now, normally when this is going to be a bad example, so I apologize to everyone, but normally when I have some furniture or some items I bought for my house and the company that I bought them from fails, that warranty is no longer valid, right? But I don't worry about the other products in my house, right? So if my, like a West Elm couch breaks and they're out of business and I call West Elm, they're like, I'm so sorry, we can't really stand behind that anymore. We're no longer in business. I'm not going to worry about my fridge, right? Or my other appliances. So in normal terms, if one bank fails, we shouldn't be worried about other banks failing. But in this case, everyone's buying the same treasury bonds and mortgage securities. And I don't know, because I don't know a lot about finance, I'm not sure if I'm getting into hot water with anyone here, but is there too much reliance on like a centralized Fed banking system? Is that part of the reason we got in this problem?
Yeah, I don't think so, because there's other investments that a bank can purchase besides treasury bonds.
Sure. So banks still have that choice.
Yeah. There's a multitude of investment types that you can purchase. Some have more interest rate risk than others. Some have some credit risk. So it's a matter of what the bank's risk profile is. Do they want to take some risk, some credit risk in their investment portfolio, or is that a safe haven from credit risk for them? Every bank has its own risk tolerance, its own profile. So I won't judge a bank based upon what they do, because their situation could be different than ours. So I don't think it's really I don't think it's a function of, the Fed has too much control. I think it's a completely different issue.
Sure. No, absolutely. Yeah. I appreciate that. So beyond the FDIC insurance, the other thing I wanted to ask about was the Securities Investor Protection Corp. Did that play into does that protect people beyond the $250,000?
No, that's a completely different program, and it doesn't really work like. I can't even exactly tell you how it works, but it doesn't really look. It doesn't protect. That would be if you're investing in stocks, for example.
Got it. So that's not a. That's
it's
not
more
a
to protect you from fraud on the part of your broker.
Got it.
If you give your money to your broker and he or she doesn't invest it, they put it in their pocket. It's to protect you from risks such as that.
Okay, got it. So there were also calls on, because going back to It's a Wonderful Life, part of the reason for the bank run was people were spreading hysteria in the streets and telling each other, and everyone flocked to the bank, and George Bailey was put in a panic position. Of course, maybe not the same thing as George Bailey also lost a giant thing of cash because his assistant left it on so that's obviously not a perfect comparison, but there have been calls, and I actually don't know if I don't know if this is political. I don't know if it's from the left or the right, but there have been calls to regulate social media in times like this to prevent pandemonium and chaos. Is that a good idea, or does that idea backfire?
I'll fall on that's a bad idea, because where does that start and stop? You know, and what's disinformation, misinformation, and what isn't? It's a slippery slope. Right. So I'll come down, even though it could work against my industry. Oh boy, I don't know that I want to go there. Right.
No, absolutely. So, what actions do people take from here on out, right? This has happened. It's always a good idea to learn from your mistakes. So I'll ask that in two categories. What do banks do, and how are banks reevaluating their positions right now? Yeah. So we'll start there. But then also, what do consumers do now?
Yeah. So there's I'll throw a couple considerations there. And I'm a community banker in Iowa, so I'm going to advocate. I'm going to advocate for community banks in Iowa.
Absolutely.
What I would say to the average listener of your show, assuming they're an Iowa resident or a nearby resident, very much, I think it's very safe to say that Iowa banks are conservatively managed. Yeah. There's a very strong history of good management among Iowa banks. Not taking excessive credit risk, not taking excessive interest rate risk, such as what SVB did, where they invested really long in their bond portfolio. So I think I would first say your deposits are, I think I can comfortably say your deposits are going to be safe in a community bank. Mm-hmm. The other thing I would, and if someone isn't comfortable with that, if they go, well, no, I want to put it in a J.P. Morgan Bank because the government isn't going to let them fail.
Oh, sure.
Okay, there may or may not be some truth to that. What I would say to you, though, is you are damaging your community because those funds are no longer in your community.
That's a good point.
There's going to be a quality of life issue that hits you sooner or later.
Sure.
Because if we don't have the funds, if we don't have the deposits in our communities to reinvest in the form of meeting loan demand in our communities, eventually your community is going to suffer.
It's actually a really good point because the money invested in a bank like Bank Iowa does directly go back into the community. It's not a marketing statement. It's that your marketing guy Jeff Fleming, who we both know would like. It's very, very real because people are going to your bank to get mortgages, to get small business loans, and if there is no deposit cash there, you can issue less of those.
Correct.
And less of those equals less growth, less businesses, fewer homes.
Yep. And our preferred thing to do with your deposits is to lend the money out. To the extent that we don't lend it out, then we put it in the investment portfolio. Then we buy treasuries and mortgage-backed securities. But our preference is to lend it out because, frankly, it's a higher yield than what we're going to earn on the treasuries.
With the final few seconds, any advice for consumers right now? Like, what should they be doing right now? Are there any actions they should take?
I do think know who you bank with.
Yep.
And if you have concerns, by all means, go and talk to your banker. Go and talk to someone in that bank. They will, if you know frontline people and they aren't comfortable answering the questions, they will connect you with somebody who is.
Sure.
That's what we've instructed all of our team members to do. Is if you have clients with questions or concerns, direct them to your leader, and we can answer their questions. First of all, if you're FDIC insured, I think you're fine. You're fine.
Yeah.
You're fine. You're not going to be any safer in any other institution than you are in the bank you currently deal with. If you're above that, there's ways to structure those deposits to get you within the limits. That would be the next line of defense. And then finally, just know who you bank with. You know, do you trust them? Do they seem like a well-managed organization? Do they appear to be taking excessive risks? And if not, I think your funds are going to be just fine.
If you're investing with a guy in the alley behind your house, it's probably not a good investment.
That might be another issue.
But even this interview is interesting because we're only talking for about half an hour, and you've already said, oh yeah, there are these such and such things you can do to protect your money in my bank. And so, like what you said is, just go have the conversation. If it's something you're worried about, if you're over $250,000, there are a lot of things tactically you can do, but you need someone to come and ask you that question so you can set it up for them the way they want it.
Correct.
Yeah, perfect.
Correct.
Jim Plagge, CEO of Bank Iowa, thank you for coming in here today. Yeah. How can people, if they want to bank with you, if they want to look up more about Bank Iowa, what's the easiest way to do that? Bank Iowa,
bankiowa.bank. There's 2 Bank Iowas in the state, believe it or not.
Oh, really?
We are bankiowa.bank, not that other one that's bankiowa.com. So bankiowa.bank, or email me at jplagge@bankiowa.bank, and I will make sure you get directed to the right person who can help you.
Jim Plagge, thank you so much for coming in here.
Okay,
I appreciate
thank you very much. I enjoyed it.
And to my fellow Iowans, Iowa expats, and Iowans at heart, thanks for listening and subscribing to the Iowa Podcast.